Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where joining me today to discuss deep value investing in emerging markets is Caroline Cai, Managing Principal, Chief Executive and Portfolio Manager at Pzena Investment Management in New York. Caroline, welcome.
Oh, thank you for having me.
It's a great pleasure to have you here, Caroline. Now, Pzena has been a committed deep value investor since 1996. In an era where growth and momentum have really dominated markets for much of the 10 years, what gives you and the Pzena team encouragement and conviction to stay the course in deep value?
I think a starting point is it just sort of makes sense to us that you should be sensitive to the price that you pay for something, and to buy a good business and pay a low price for it. We think the philosophy of buying it when something has gone wrong that's obvious to everyone, but the resolution isn't, is a reasonable way of navigating the volatility and the uncertainty that the future necessarily presents. For us, it just comes down to the price you pay for something is the best indicator of potential long-term returns.
Here we are in the second quarter of 2026. Q1 26 was genuinely volatile. We saw peak to trough declines in emerging markets of around 14%. When the world feels uncertain in most asset classes, but particularly in this asset class, Caroline, how does Pzena think about risk in the portfolio? And does volatility like this, do you feel that creates opportunity for you, or something that tests the resolve of the portfolio management team?
Yeah, that's a great question. Probably both. One, if stock price never moves, how do we create generate alpha for our investors? So we like environments where the stock prices are moving. And look, at the moment, EM returns are being driven by some of the chip companies that supply to the AI infrastructure builders, and the rest of the business that we see in emerging markets. Some of them are very high quality, are almost left on the side. And ultimately, our view is the best way to expose yourself to great opportunities is when whatever people should be worried about is already happening and are reflected in the valuation. So in emerging market, you have a lot of opportunities to really worry about things. And our view is to get involved after whatever you should worry about is obvious, and pay a low price for it is a reasonable way to navigate it.
AI is arguably the defining investment theme of the current moment in markets. But for a deep value manager, I would imagine that cuts both ways. So what's the thinking on AI? Do you see it as a threat to some of the companies in your portfolio, or are there companies in your emerging markets fund that you believe are actually mispriced because the market is overstating the risk of disruption?
Absolutely. Anytime people are potentially overreacting and underappreciating the resilience of a business franchise, that's a great opportunity for us. So certainly, if you look at the market reaction, the market is worried about all sorts of different industries getting disrupted. In our specific emerging market portfolio, some of the IT service companies that we're invested with is certainly at the front end of disruption risk. So we have both Globant, a Latin-based IT service company, and Cognizant, an India-based one, in our portfolio, although collectively they're relatively small exposure at the moment, because we do think we're in the early days of really assessing how businesses can navigate the environment. But if you look at the IT service business, our view is you need their help to move to the world of AI implementation. Most businesses do. And the valuation is such that just looking at their back book, it largely pays for itself. You don't even need a future beyond what the business is already booked as potential revenue. On the other hand, if we're right about the technologists are still relevant and needed in this transformation of the infrastructure for most businesses, then you have tremendous upside embedded in there. So it's really the risk-reward asymmetry that we typically look for that's allowed us to be an investor in IT services.
Your portfolio has a significant overweight to Brazilian stocks, and Brazil is a funny kind of emerging market. It was obviously, when the term BRICS was coined, it was the first name of the BRICS, but it's had a complicated few years of late, politically and economically. So can you walk us through how you arrived at this strong conviction about Brazilian stocks, and then maybe point to some holdings that illustrate the value that you're seeing there?
Sure. As I mentioned earlier, our view is the price you pay for something is the only thing you know for certain today. So we're very sensitive to the price. And we think today you are able to access some of the best businesses in Brazil and in the world at a very low valuation, especially compared to what you had to pay 10, 15 years ago when the BRIC terms were first coined in multiple. And it comes back a little bit to kind of what makes value interesting emerging market, because everything we loved about Brazil back 15 years ago, it's all still there. Huge country, resource rich, good demographic trends, potential for productivity growth. On the other hand, because things haven't gone well, you are able to pay a very low price for that same future. So when you look at our portfolios, it runs across a fairly wide range of businesses. INDepth is a pretty good example. It's probably one of the best consumer franchises that you can find in the world. An end product that's relatively, how should I say it, stable in demand, because people like to drink beer. And they have the dominant market share and a full spectrum of brand portfolios. However, margin has been under pressure because the weak macro has led to difficulties of passing through price increases, even though their input costs have been rising over time. We don't think it's a question of if, it's really a question of when. It will take some time to pass through the price increase, but they will be able to do that and restore margins over time. And for the best, a clean balance sheet, great franchise, you're paying in the high single-digit range for price to normal, as we estimate it, and that's a very attractive entry point.
And a World Cup in the offing that's arguably going to generate bigger beer sales than normal.
Yeah, but it's a short-term event, but certainly helps.
Caroline, in a world where there are so many competing arguments about the forces that are moving wealth portfolios, what would you say to an advisor who's sitting on the fence right now about adding emerging markets to client portfolios?
Yeah, so I would say emerging market definitely provides exposures that are different versus what you can find in developed world when it comes to the macroeconomic cycles, but more importantly, the specific businesses that you can expose yourself to. On the other hand, if you look at emerging market index today, it's really being driven, the returns at the moment is being driven by the same thing that we see everywhere else in the world, AI. So I think an active approach is a good way of entering the market. And the value, given the starting point of valuation that we see, we think has a role to play in anybody's portfolio. And I would also preface it with, we're actually seeing value stocks in both developed world and emerging market, looking at trading at similar levels of starting point of valuation. So at the moment, the starting point of valuation is not exceptionally cheap for EM versus the rest of the world, which is somewhat unusual, but it's a fact. So I just want to put that caveat out there.
This has been INDepth with Caroline Cai, who's Managing Principal, Chief Executive and Portfolio Manager at Pzena Investment Management. Caroline, thank you for taking us through emerging markets from that perspective of a deep value investor.
Thank you very much for having me.